You're 61, retirement is 14 months away. You've got a number in your head, the number that means you're finally done. And for the first time in years, you actually believe you'll hit it. Then you check your account on a random Tuesday morning and your stomach drops. Down 18%. In about 7 weeks. Nothing you did caused this. You didn't panic. You didn't touch a thing. The market just did what markets occasionally do. It fell off a cliff with no warning and no apology. And now you're doing the math nobody wants to do. Is this 14 months? Or is this 5 more years at a job you've mentally already quit? That moment, right there, is the single most avoidable financial gut punch in personal finance. And the tool that prevents it is one almost nobody gets excited about. Bonds. I know. Bonds have the reputation of being the financial equivalent of a beige minivan. Nobody's bragging about their bond allocation at a dinner party. There's no bond hype account with a rocket emoji in the bio. But here's what I want to show you today. The most boring asset in your entire portfolio might also be the single most important decision you make before you retire. Not because bonds make you rich, that was never their job, but because they determine whether the wealth you already built actually survives contact with a bad year at the worst possible time. By the end of this video, you're going to understand exactly what bonds are doing for you, why the timing of a crash matters more than the size of it, and how to figure out the right amount for your own situation, without a finance degree. Let's get into it. Let's skip the textbook definition. You already know the basic idea. You lend money to a government or a company, they pay you interest, you get your principal back later. That part isn't the important part. The important part is the important part. Bonds are hired to do inside your portfolio, and that job is almost never make me rich. Here's a picture I want you to hold on to. Think of your portfolio as a ship. Stocks are the sails and the engine. They're what actually moves you forward. They catch the wind. They build momentum. And over 20 or 30 years, they're what turns steady contributions into an actual retirement fund. Bonds are the ballast. The heavy, unglamorous weight sitting low in the hull that nobody thinks about on a calm day. Nobody photographs the ballast, but the moment a storm hits, and at some point, a storm always hits, the ballast is the reason the ship rocks instead of capsizes. That's the entire job description. Bonds aren't there to win the race to the horizon. They're there so a bad storm doesn't sink you right as land comes into view. Here's a real pattern I want to walk you through, based on 2 retirees whose situations tell the whole story. I'll call them Benjamin and Victoria. Both retired within a year of each other, both with almost identical account balances, both having done everything the personal finance playbook tells you to do. Maxed their accounts, kept fees low, stayed disciplined for 3 decades. Then, right as they both started withdrawing income, the market took a sharp, ugly drop. Victoria made it through without much damage. Not because she was smarter, and not because she guessed the crash was coming. She'd simply kept several years of living expenses sitting in bonds. When stocks dropped, she pulled her income from the bond side and let her stock portfolio sit untouched, recovering quietly in the background. Benjamin didn't have that cushion. He had to sell stocks at depressed prices just to cover his monthly expenses, which meant locking in losses at the exact moment he could least afford to. Same crash, same decades of discipline, wildly different outcomes. And the difference wasn't luck, it was ballast, decided years in advance. So if the takeaway from that story is simple, it's this. Bonds don't exist to make your retirement bigger. They exist to make sure it survives. Ask yourself something honestly for a second. If the market dropped 25% tomorrow and stayed down for 2 years, where would your income actually come from? If your honest answer is, I'd have to sell stocks at a loss, that's not a hypothetical problem. That's a real gap in your plan. And bonds are usually the most direct fix. This is exactly where a concept called sequence of returns risk comes in, and it sounds far more intimidating than it actually is. Here's the core idea. While you're young and still adding money every month, the good years and bad years arrive in barely matters. A crash early in your career is actually great news. You're buying shares on sale for years afterward. A crash right at the end of a 40-year career is fine too, because you've got decades already banked and no urgent need to sell. Retirement flips that completely. Now you're pulling money out instead of putting it in. If a crash lands in the first few years of retirement, right when you're withdrawing instead of contributing, the math turns genuinely brutal. You're forced to sell shares at depressed prices just to fund everyday life, which permanently shrinks the pool of money that has to last you for decades. Two retirees can post the exact same average return over 30 years, and one runs out of money while the other leaves millions behind, purely because of when the bad years happened relative to when the withdrawals started. You don't get to choose when the market has a rough patch, but you do get to choose how exposed you are to it. This is where bonds stop being a nice-to-have and become an actual retirement-saving mechanism. If you're holding 3 to 5 years of living expenses in bonds when you retire, a crash in year one doesn't force a single stock sale. You simply draw from the bond side, let the stock side recover undisturbed, and go about your life. It's not thrilling. It's just remarkably effective, and it matters far more the closer you get to the withdrawal phase, regardless of your exact age. Now let's talk about the part that almost never gets discussed. And honestly, it might matter just as much as the math. A portfolio that's entirely stocks isn't just risky on a spreadsheet. It's risky in a how well do you sleep at night sense. And poor sleep leads directly to poor decisions. When markets fall and your entire net worth rides on stocks, panic isn't some rare exception. It's close to the default human response. We're wired to treat a sudden 40% drop as a genuine threat, and threats trigger the instinct to escape. So people sell. Every single crash, otherwise disciplined people convince themselves this particular downturn is different, that getting out now and getting back in later is the smart move. Almost nobody times that correctly. They lock in the loss and then miss the recovery entirely. Here's what a meaningful bond allocation actually gives you that rarely gets mentioned. It's not just a math strategy, it's an emotional stabilizer. When part of your portfolio barely moves while the stock side is dropping fast, it gives your mind something steady to hold on to. It's the difference between watching a storm from a life raft that's already in the water versus watching it while still trying to figure out if you even own one. People with a real bond allocation are measurably less likely to panic sell during downturns. And that single behavioral difference can be worth more to your long-term outcome than almost any tweak to your expected average return. So how much bond exposure is actually right for you? There's an old rule of thumb that's been circulating in personal finance for decades. Your age in bonds. 30 years old, 10% in bonds. 60 years old, 60% in bonds. It's simple and memorable. And honestly, probably a bit too conservative today, given how much longer people are living and how much further retirement savings now need to stretch. A lot of modern planners lean towards something closer to your age minus 20, which leaves more room for growth over a longer horizon. But formulas like this ignore your actual life. And that's where I'd push back on relying on either one too rigidly. Let's bring in Olivia here, a financial advisor whose approach I think gets this right. She doesn't start with a percentage. She starts by asking what guaranteed income a client already has coming in from a pension or Social Security, how flexible their actual spending is, and how they personally react when they see red numbers on a screen. Someone with a solid pension covering most of their basics can reasonably afford to run a more aggressive portfolio elsewhere, because a bond-like income stream already exists outside the portfolio. Someone relying entirely on their portfolio for income needs a sturdier bond foundation, because there's no other safety net underneath them. The framework Olivia, and honestly, most thoughtful planners, favor instead is thinking in years of expenses rather than a flat percentage. Work out your essential annual expenses, the non-negotiable costs you're covering no matter what the market is doing, and aim to have somewhere between 3 and 7 years of that amount sitting in bonds or similarly stable assets as you approach and enter retirement. That reframes the entire question from, what percentage should I own, to how many years of runway do I actually have before I'd ever be forced to sell stocks during a downturn. It's a far more human way to think about the same decision. I want to be straight with you here, because personal finance content has a bad habit of oversimplifying things until they're technically wrong. Bonds are not risk-free. Bonds carry interest rate risk. When interest rates rise, existing bond prices tend to fall, and longer-term bonds feel that swing more sharply than shorter-term ones. Inflation is a separate threat entirely. It can quietly erode the purchasing power of your bond income if you're not paying attention to it. Bonds are a tool, not a guarantee, and like any tool, it only works well when you understand what it's actually built for. Quickly, because the differences matter, Treasury bonds issued by the government are about as safe as this asset class gets, which is exactly why they pay less. Corporate bonds pay more, but carry more risk, depending on the financial health of the company behind them. Municipal bonds can offer tax advantages depending on where you live. And bond funds or exchange-traded funds bundle a large number of individual bonds together, so you're not stuck building a bond ladder rung by rung on your own. For most people watching this, you don't need to become a bond-picking specialist. A solid, low-cost bond index fund, or a target date fund that automatically rebalances for you, handles the vast majority of this job without requiring a finance degree. Retirement was never purely a math problem. It's the result of decades of decisions, sacrifices, and a fair amount of trust. Trust that if you did the work, the plan would actually hold up when you needed it to. Nothing tests that trust, quite like watching your balance drop right when you can least afford it to. Bonds are, in a real sense, a promise you make to your future self today. It's you saying, I can't control what the market decides to do, but I can control how exposed I am when it happens. Nobody's making a documentary about the retiree with a well-balanced bond allocation, but that quiet, unglamorous decision, made years in advance, is very often the exact thing standing between a retirement that survives a bad year and one that gets derailed by it. So here's what to actually take from this. First, bonds aren't there to make you richer. They're there to make sure the wealth you've already built actually lasts. Second, pay attention to sequence of returns risk, especially within about a decade of retiring, because timing matters more than most people assume. Third, take the psychological side seriously. Your ability to stick with a plan during a crash is worth just as much as the allocation on paper. And finally, think in years of covered expenses rather than a rigid formula, because your situation is yours, not a textbook average. If there's one thing worth doing after this video, it's just going and looking honestly at your own portfolio. Not to overhaul everything overnight, just to ask yourself, if the market fell apart tomorrow, do you actually have a plan, or are you just hoping for the best? Give your future self the ballast, not just the sails. If this was useful, hit like, drop a comment with where you're at in your own retirement timeline, and subscribe for more videos like this one. Thanks for watching. I'll see you in the next one.